Afternoon. Welcome to the Retirement Essentials Touching Base webinar. We're really delighted to have you with us this afternoon. It promises to be a really terrific session. My name is David Kennedy. I'm the Head of Advice at Retirement Essentials. Shortly, I'll be joined by Nicole Bell, one of our Senior Financial Advisors, who's going to take us through this afternoon's presentation on ways to make the most of your retirement savings. That'll be followed by some Q&A. You'll hear from our advice team as they answer questions on a range of retirement scenarios. There's a couple of housekeeping issues we should attend to up front. If you could please ensure you're on mute, that would really help with sound quality for all participants. And if you'd like to submit a question for our Q&A, you can do that in the chat function. There'll be a link there to a Google slide. And you'll be able to submit your first name, a question to the Q&A panel, and we'll endeavour to get to as many of those as we can towards the end of the session. Lastly, I will point out that any information that we share with you today is of a general nature. It doesn't take into account your personal situation, and it's now my pleasure to introduce Nicole Bell, Senior Financial Advisor at Retirement Essentials, who's going to take us through this afternoon's session.
Okay, good afternoon, everyone. Thank you so much for being here. This is April 2025 touching base webinar. So really just trying to connect with our community and trying to let you know what ways, guidance we can provide to sort of enhance what your retirement might look like, give you some ideas, and hopefully set you on the right track and give you a sense of, so many different factors of retirement that can be confusing. Thank you so much for your patience. I'll just cover off, first of all, some of the things that we can expect from the agenda. So what we like to cover firstly is just some of the changes that have been coming up. So obviously the federal budget came out very recently. We are going to cover off the highlights only. So I'm not trolling through the entire federal budget, but what we have picked out is bits that are relevant, are positive, or may impact our sort of pre-retirement and retirement community. So we'll pick through those first of all, and then we'll probably go through some of the age pension changes. We will go through some of the age pension changes. This is just the changes that happen. There are adjustments to thresholds, payment rates, things like that. Various changes that happen in March, July, and September every year. So obviously there's been some recent changes of 20th of March. We'll cover off what those look like. Then we will also look at ways to maximise your entitlement. So this is just a really some small suggestions that can make a difference in terms of age pension entitlements, eligibility, that kind of thing. And we like to run through these because some of them are really small and don't necessarily have big changes, but they can have a significant difference in terms of what you're getting and what you're entitled to. And after that, really want to work through a scenario that I had last week with a couple of customers, because I think it really highlights a point of confusion that we have found has arisen between different customers in the past. So we want to clarify what that looks like, but also just look at ways in this particular situation where we optimize super, save some tax, and sort of position them as best as we could to cater for themselves in retirement. And once we get through that, we'll cover off the retirement health check. So really just highlighting the importance of being really prepared and making sure that you're working through all the things that you need to consider if you are approaching retirement or even already in retirement, but probably don't have as much knowledge as you'd like to have. And then my favorite part, the question and answer session. So continue to type your questions in the chat. We're going to hopefully pick out some to go through towards the end of the session and just hopefully answer some of your questions while we're here. So it won't just be me, will also be my lovely colleagues, Andrew and Amanda. They are very knowledgeable and will give us a lot of insight into a lot of the answers that you need. So looking forward to that. But in the meantime, federal budget it is. Let's see where we start. So the first point here actually wasn't a federal budget, but it's more just highlighting the fact that deeming rate changes. We are going to talk about this a little bit more later on. So don't worry if you're like, deeming rates, I don't know what that means. Nobody does. Most people don't. It's a confusing point. We were expecting a big announcement around deeming rates, whether they remain frozen, whether they're adjusted, and it was just crickets, absolutely nothing. So we're still awaiting that, but we'll talk about that a little bit later in the session. In terms of the actual federal budget highlights, modest tax cut, and this will be seen not next financial year, but the following financial year. And, you know, what is an election budget without a tax cut? So it's not unexpected and it is small, but I am pleased that this is applied to the lowest marginal tax rate, not top marginal tax rate. So, yeah, there'll be some changes coming through, hopefully, 1st of July 2026. Every little bit helps. Energy bill relief, look, this one was really just a continuation of the existing arrangement where we're all getting that $75 subsidy each quarter on our energy bills, and they're continuing for another 6 months. So obviously wouldn't commit to another full year, but, you know, we're getting it for another 6 months, which is better than nothing. Number 4, so this one I think is relevant to a lot of people. So if you don't have a concession card, and you go to the pharmacy to get your prescription medicines. If you have a Medicare card, but you don't have the pension and concession card, you may pay up to $31.60 for a script at the moment. That was the price set January this year. From January next year, they're looking at reducing that down to $25. So that's going to be a little bit of a relief for anyone who has sort of multiple medications that they're trying to juggle and trying to afford. There was also some announcements around increasing funding to aged care, and in general, that's a separate issue. The announcements here were really focused around funding for aged care workers and salaries and things like that. So it's really important with an aging population that we are able to keep and retain really good stuff in that space so that people are really well taken care of. So that was positive. And increase to the Medicare low income threshold. So this one is just, you know, you have to have a higher level of income before you start paying that Medicare, which is you know, a slight change. This one has a potential to be really beneficial for a lot of people. This one's my favorite. You're not supposed to have favorites, but if there was one, this will be my favorite. However, I will say that this one has very much, it's very much an election budget kind of bulk billing incentive kind of energy. In saying that, there is this targeting 90% coverage by 2030. So there's this concept that we're going to have 90% of these GP visits, or 90% of medical practice is actually bulk billing by 2030. But in context of the situation, I've spoken to multiple people who have concession cards and can't in their local area or with their GP, etc., access bulk billing. So if we have concession card holders already, the idea that 90% of the population at that point in time would actually have be able to have bulk access to bulk billing, it would be fabulous. Even just a guarantee that all the concession card holders would be able to access it would be good. So they don't ultimately have control at the end of the day over whether those medical practices offer bulk billing or not. All they can do is just give them incentives to do so. But I think that this is a massive step in the right direction because, I mean, everyone, I think, who is paying a gap has felt that gap slowly increase. Well, not even that slowly, to be honest, but significantly increase over the last 5 years or so. So that's a wait and see, watch and learn, see what happens. But I'm probably most excited about that one in this federal budget. There wasn't anything that was groundbreaking as such, but that one has the potential to be really good. And the last point, and this was not actually with the federal budget, I just wanted to address this. So this is for concession card holders. So if you are a concession card holder, you go to the pharmacy for a PBS listed medication, you pay maximum $7.70. You already did, but they on the 1st of July, they announced that that's frozen and that you should be able to pay a maximum of $7.70 for up to 5 years from January this year. So that's why it wasn't probably addressed in the federal budget, because that was already sort of locked in before this happened. So the fact that that still seems to be in place is a positive. But now there's an additional potential discounts for those Medicare card holders that don't yet have a concession card. So this one is not tied to the budget specifically, but it just seems to be an opportunity that kind of arose about 3 years ago that we're consistently seeing that clients weren't aware it was an opportunity and weren't aware that was kind of missed. So this headline of like Australia's death tax sounds very dramatic, I'm aware, but I like to use the example of when we were all sort of watching Downton Abbey and someone passes away and they're selling off the land to pay the death taxes, and we think to ourselves, we're so lucky, we're in Australia, we don't ever have to worry about that. And that's true to a certain extent. You know, we've got the family home and we're protected from a lot of those death taxes. But what a lot of people don't realize is that there's this sneaky little tax in your super, potentially. So superannuation death benefit taxes. Now, I want to be really clear here. Couples, so spouses, if you're inheriting superannuation from each other, but you're a beneficiary of your spouses, then you don't pay that tax. So just as a broad statement, that doesn't exist there. This really is most prominent where ultimately the remaining superannuation is going to adult children or extended family, charities, etc. So primarily impacting adult children for funds that are sitting in super. So kind of how this works is throughout your working life, as you accumulate your super, you most of the time it's accumulated through a combination of employer contributions and salary sacrifice contributions. And these are tax-friendly contributions at the time. But what it means is that they go into what we call the taxable component in super. So most people's superannuation is primarily, if not 100%, taxable. And what that means is any taxable balances, when they get inherited by those adult children or extended family, they pay 17% tax on the balances that they inherit. So this potential opportunity for some people exists where it's called a recontribution strategy, where we can effectively take money out of super and put it back in. And what we do is we kind of wash some of the tax out or all the tax out, depending on your situation. So we take it from being, say, taxable to what is classified as tax-free component, and your kids don't pay tax on those components. So the reason that this was sort of a change 3 years ago was that if anyone was in retirement over the age of 67, you couldn't do this because unless you were still working, and then even then the amounts each year was sort of limited. But 3 years ago in 2022, almost 3 years ago, what we had was a situation where the government said, no, if you're over 67 all the way up to 75, you don't have to keep working to make these types of contributions. You can just make them. You go ahead, chuck some money into super. So obviously that's within context of your circumstances, but it created this opportunity for people that were maybe even already retired, 67, 68, thinking everything's sort of ticking away. It created this opportunity where we could, at that point in time, potentially minimize that tax by, implementing something like this recontribution strategy. So I would suggest having a look at this if this is important to you. So if you weren't aware of this, it wasn't important to you, really research whether this potential exists. There's a really great point in time, which is when you reach retirement and can access your super, that we may want to look to do this. But if you're already in retirement, you haven't missed the boat, we can make these types of contributions all the way up to 75. But there are limits on the amounts, and depending on your balance of your super, it's not as simple as taking out and putting it back in. But it's definitely worth exploring. So just wanted to highlight that. It seemed to just be a missed opportunity and a little bit of confusion there for a lot of people. So moving on to age pension changes. So if anyone's on age pension, they may have realized that there is a very, very tiny little amount extra in your bank account each fortnight, if that's come through yet. Look, I think what we said was for a single person, a maximum increase of $4.60 a fortnight, which is the equivalent of maybe a small coffee at your local coffee shop. And for couples, about $7 per fortnight. So you guys get to share a nice latte because cold coffees are more expensive than hot ones, apparently. Look, I know that it doesn't seem like a significant increase at all, but I will note that, look, it really has just dialed back to more typical levels because it's just tied to increases in things like inflation and other factors. And so we have just seen some really fairly impressive increases relative to historically over the last sort of year or two. And this is really just getting back to, I guess, more typical levels of increase. So and every little bit helps, but, you might want to save it up for 6 months' time when your energy bills go back up and try and bank a little bit before then. But yeah, slight increases, every little bit helps. Now I'm gonna pause here. I'm not going to go through it. This is your asset thresholds. So as I said, there are changes that we make every March, every July, every September. to the thresholds for age pension. And when we look at these thresholds, March, they increase the upper thresholds a little bit. So that's the point at which if your assets are low enough, you can start to be eligible for a little bit of age pension, maybe look at claiming your pension and concession card. But when I say small increases, for example, if you're a couple who own your own home, the maximum level of assets, assessable assets you can have and still be eligible is 1,047,500. Now, prior to this increase, it sat at about 1,045,000. So you can see that the increase was a little bit incremental, but that's just, over time, slowly creeps up, and that's where we're at the moment. If you've not been eligible before because of assets, always really important to keep an eye on these thresholds and identify the point at which in the future you might scrape under. So I'm going to go back to what I parked when we were talking about the federal budget, because this was the nothing announcement, like they literally said nothing. But the reason that we've had articles about this and we keep coming back to this is the potential for any changes to the deeming rate to affect a lot of people already on the age pension or approaching age pension age. So at the moment, there is zero announcement. So deeming rates are really low, historically low, and they have been for many, many years. Even with all of the interest rate increases that we've had over the last 5 years or so, we have not seen any increases in deeming rates. So deeming rates really impact people's age pension calculations under the income test. And why this is important is for a lot of people, if they are already income tested, then any increases in deeming rates may have an immediate impact on the age pension they're currently receiving or going to receive. And even for some people, if it's more, they don't have employment income, any other forms of income coming in other than what they're drawing from super, they're probably more used to just worrying about the level of assets. Depending on the increases, changes in these deeming rates could see those people, depending on what they have, suddenly start seeing an impact, further impact on your age pension entitlements. So if these go up, you could be sitting around doing absolutely nothing, doing no changes to your circumstances or anything, and suddenly you're getting a lower age pension. So obviously you can see that we're hoping that they'll continue to keep them frozen because that benefits our community the most. So at the moment, it's benefiting about 460,000 age pension recipients who are currently income tested, and therefore, it benefits them to keep it on hold. Any increases will impact those people immediately, but that doesn't factor in any additional people that may be impacted depending on how much those rates increase. So deeming rates impact your assessment under the income test. So until we know what's happening there, let's just assume no news is good news and keep our fingers crossed that they keep them frozen. So we did actually reach out to the Department of Social Security just to sort of figure out, come on, like what's happening. We thought that, this was going to happen. There was no announcement what's happening. And there was a very diplomatic answer there, which was very much like they are frozen as per the last announcement until we make another announcement that they're not, or until we confirm that they are. So it was a nothing answer, unfortunately. But as soon as we find out or are able to officially confirm either way, you guys will be the first to know if you subscribe to our newsletter. So absolutely sign up for that. Hoping that you are. That's how you got to this webinar. Keep an eye out for it. All right. I like to cover these off because if you are on a part pension, or you're likely when you get into retirement to be only on a part pension, particularly if you're asset tested, but also income tested, there are some ways where you can help to just enhance the amount of entitlements you may be eligible to receive. Now, this is particularly for people who are already on an age pension, but not a full one. Review your personal assets. I know it seems really, really obvious, but let me be very clear. Centrelink doesn't depreciate. So if you have a $50,000 car when you apply for the age pension, and in 10 years' time, Centrelink will still think that you have a $50,000 car. Now, unless it's a collector's item, this is not going to be worth $50,000. It's probably significantly decreased. So if you've been on age pension, you're 75, you've been on age pension for 10 years, and you've never reviewed this, you're getting a part pension, you're within that kind of part pension asset space, you go back to Centrelink and you say, okay, it's not worth $50,000, it's only worth $30,000 now. You've decreased your assets by 20,000. You've increased your age pension by $60 a fortnight. So it's a really simple win. You're not compromising on your financial circumstances. You're not changing anything. You're not taking more risk. It's not costing you money. Just go invest the 5 minutes it takes to update that asset value, and you'll start getting paid more. So this is one of my favorite in terms of a simple win. Another common way is to think about, especially approaching retirement, or even if you're in retirement, if your super and other assets exceed the lower asset threshold and you have outstanding personal debts, like a mortgage on your home, personal loans, credit cards, that kind of thing. It can be an easy way to reduce your assessable assets, potentially maximize your entitlements. But I do like to put the caveat there. It's not as simple. I don't want everyone to run out and just take money from their super and pay off their mortgage. That may be the right decision, but there are a lot of other pros and cons and other factors that we need to weigh up. So probably please get some guidance on that before you actually take any action, and make sure it's the right choice for you. Now, this one you may have seen touched on in our newsletter. It's pretty typical. This is specific to couples where there is an age gap, and somebody's over age pension age, someone's under age pension age, where eligibility exists for some age pension under the asset test, potentially income test, but more asset side of things. We have an opportunity potentially look at shifting where the assets are to maximize the age pension just for the period between your 67th birthdays. So it is a limited time benefit, but it has actually proven to be quite powerful if that's the situation that you're in, especially where a lot of the superannuation assets are lying in the older spouse's super. So we did a previous sort of case study on this in a previous webinar, and we definitely have some articles available online about this one. So if that sounds relevant, check it out, but I would encourage you to book an appointment to actually work through what that looks like for your exact situation. So this one's for people that are sort of close to the cutoff point. They're working full time. They're a little bit over, the over age pension age or about to be, and they're a little bit over that kind of income threshold. We've had people come and make appointments so that we could sit down and go, okay, what if I went 4 days a week? I would scrape under the threshold. I'd get a little bit of age pension, but I'd also get these extra discounts. And how does that work out in terms of me managing my income moving forward? 3 days a week, 2 days a week, whatever that looks like, especially in a situation where you don't have a lot of resources behind you, you don't feel super confident just pulling the plug completely, or you just like working. You like working, but you maybe want a little bit more balance. It would be really nice to get a few discounts and some help, but we need to figure out where that might lie, if there's a bit of flexibility there with your job. And last but not least, gifting. So this is one of the things that people tend to be most confused about, if anything. And I think one of the things is this whole concept that there are rules around gifting makes people think that if they give their money away or they help their kids, they're going to be somehow punished for it. Now, that is not really the intent of these rules. You will not immediately significantly improve your age pension entitlements by giving money away, but you won't suddenly receive less than what you're already getting in terms of gifting. So there are small amounts, $10,000 a year, up to $30,000 over 5 years and things like that, which are sort of ignored, but significant amounts above that. But it can be really relevant if you're planning retirement in the future, want to be able to help your kids, know that you have a lot more assets than what you need. It can be looking at gift that, but please get some guidance on this ahead of time. I've had people that have, and it's a hard situation to kind of explain, but borrowed money against their family home to give to their kids so their kids could buy a house. So what we had is equity in the home, which is not assessed for age pension purposes, and they've turned it into a gifted asset that sat on their list of assets for 5 years, which they couldn't then reverse because their kids bought a home with it. So please just seek advice before making any significant changes like that, because you do not want to get caught in some of the really strange and frustrating Centrelink rules when it comes to things like that. Okay, so this is the case study that we want to have a look at, because when I was chatting to Andrew and Amanda, and we were talking about a lot of the things that people tend to come to us and are confused about. And that was the situation with John and Jenny. John is 70 and he's just retired, and Jenny's 60 and she's still working full time and happy to keep going. So John has retired, and when that happened, Jenny sort of cancelled her salary sacrifice, because once she did that, she's actually bringing in enough. She's bringing in enough to keep them comfortable. live the life they want. They don't feel like they're tightening the belt. It's like a really good balance for them. So her net income of about 77,000 after tax is keeping them quite comfortable. So John came and he said, look, I know when I retire, I need to start drawing from my super, but I don't want to. I just want to keep it invested. I just want to compound it. Please don't make me do it. Because I think that there are some old legacy rules that kind of spoke to this in terms of having to draw down at certain times, if you let your super fund know, and just things like that. So John's saying, I don't need it. Jenny's income covers everything. Happy days. Just tell me I don't have to start draining my super. That was actually the word he used. Draining is super. What we discussed, first of all, no. If your money is in an accumulation account, which is where your contributions and everything go in, and that's where your money's grown, you don't ever have to draw money from that super account. You can leave it there forever if you want. And so that could have been the end of the conversation. It could have been happy days. We have the income we need. I'm going to keep compounding my super, and they still would have been okay. But obviously, I wanted to say to them, however, let's have a look at maybe what we could do to sort of optimize the situation a little bit, because you are paying like fairly significant amount of tax here. So there is some substantial benefits to doing it. So first of all, remember how I said Jenny cancelled her salary sacrifice because, they couldn't really afford it, but when she cancelled it, they had exactly what they needed, because she was salary sacrificing as much as she could when they had the two incomes coming in, because they were fine. Now we've kind of eliminated that, but what's happening is that she's paying more tax. So what we could look to do is, if we are drawing a regular income from John's super, we're taking that money and we are, helping out their cash flow. So Jenny then has capacity to go back to salary sacrificing or making, tax-friendly super contributions to her superannuation. So even though John is draining his super, it wasn't really the disappearing into the ether, it was building Jenny's super. So as a household, they're still growing and compounding their retirement savings, but they're also having a net tax saving of around about $3,000 with the levels of income and super contribution amounts and things like that. So that's happy, that's great. We all want to save tax, but in addition to that, I just wanted to point out, and this comes back to like the death tax, sneaky tax, not a death tax, but it is another sneaky super tax. So what a lot of people don't realize is, if you have super and accumulation, you are paying tax on the earnings of those funds. So it's inside there, and it, obviously invested on your behalf in a bit of shares and cash and all those kinds of things. And then they're taking out their 15% tax before they pass the earnings on to you. So it's a tax concessional environment, a tax-friendly environment, but it's not a tax-free environment. In retirement phase of super, pension phase, account-based pension, whatever you want to call it, earnings are tax-free. So I actually looked at John's specific situation and who he was invested in. He was in a balanced option. And we looked at the average 10-year returns for that balanced option in his accumulation account. And we looked at the average 10-year returns for the balanced option if he'd sat that money in a pension account. And he was getting about 0.7 to 0.8% more, which on his balance meant that the earnings were actually about $3,800 a year higher, because we parked that money in a pension phase. He's taking the 5% out, but we're reinvesting it anyway, and we're getting higher earnings on the bulk of those investments. So combined, what we've ended up with is about $6,800 a year, essentially less tax because we're not taxing the earnings, less tax because Jenny is salary sacrificing and paying less personal tax. So we've saved close to $7,000 a year. Actually, it might be higher depending on, if Jenny hadn't been salary sacrificing up to the maximum in previous years and a balance was under 500, we could actually get more tax savings, but I won't go into too much detail and confuse everyone. Another potential future benefit is we're actually reweighting some of the assets over time from John's super to Jenny's super. If she chooses to retire before the age of 67, that could be beneficial to have a larger amount of assets sitting in her super as opposed to John's. But we would review it closer to the time, and we can make more significant changes a little bit closer. She doesn't know yet. She likes working. She doesn't know yet if she's going to retire or when. But that then prompted the next discussion. So came back and we had a talk, because she said, okay, I don't want to retire, but I want to know that I could retire if I wanted to, which sounds like, it doesn't make sense. But she's currently really enjoying working. But if anyone has been in this situation before, you know that that can really change quite quickly depending on what happens in your work environment, how you're feeling physically, other sorts of things. So she wanted to aim for a retirement age of 65, but she also wanted to look at, oh, but if I really was over it by 63, could we afford to, etc. So we ran through what that could look like. Retiring at 63, retiring at 65. They just want to feel confident that they're put themselves in a good financial position because they want to maintain their spending. They enjoy their life. They don't want to count their pennies. They want to just keep doing what they're doing and really keep spending at the current levels and just have confidence. They might not always want to, but just have confidence of knowing they could if they wanted to. So we just looked at their wealth over time. As you know, no one has a crystal ball. We don't know what's going to happen. So we just wanted to go, all right, what's the universe of possible outcomes here? Here's your balance. Here's how much you're spending. Here's how you're invested. What would our situation look like if things went really well? What would it look like if things went really badly? And the universe of possible outcomes. And we could look at that together and figure out how confident they are in making some of the changes or, different retirement ages, that kind of thing. So able to go through that. The outcomes were really great there. One of the things is people often underestimate how long their money will last. And when we're able to demonstrate how the age pension participates in the income you're receiving in retirement over time. So over time, even if you don't get initially a full age pension entitlement, then there's this kind of inverse relationship or inverse correlation between the level of assets and super that you have and the amount of age pension that you're eligible for. So as you're utilizing your assets, because you're primarily self-funding your retirement, your age pension's incrementally increasing. You then have to take in subsequent years less from your super to achieve the same level of income and that sort of thing. So we're able to demonstrate how it works, that their money ultimately ends up lasting that long given the spending levels that they're looking at. So that was a really great outcome for them. We would make some adjustments close to the retirement age, but we didn't really address that at the time because that's not a decision. With so much uncertainty around Jenny's actual retirement age, there was just no reason to consider making changes right now, but they'd sit down and we'd have another look at it closer to the time. So I just wanted to jump back to the retirement health check because this is a service that we've recently added. What we have found is so many people coming through. We've had a retirement advice consultation available for some time, which is fabulous. So many people are coming going, all right, I'm retiring next month. What do I do? I want to apply for the age pension, or they're downsizing their home, or they don't know what to do in terms of their superannuation, their choices, how to make good choices, how to optimize their situation, just understanding how it all works. But the retirement health check is particularly for people that have no idea where to start, haven't thought about it. They're at the start of their journey. They're like, oh, retirement's coming up. Probably should figure out what I need to do. And so the retirement health check really allows us to actually go through your situation, your lifestyle, your goals, and figure out what should I be thinking about? What should I be thinking about right now to optimize my situation for the future? And to essentially going through a to-do list together of, okay, do I have, because so many people are, do I think of super first or age pension, and which one do I do? And it's all a little bit confusing. So if you want to sit down, figure out and go through, look, these are the things we need to consider. These are the things that are relevant to you. Let's make an action plan. Here's what we're going to look at first. That kind of experience, I would highly recommend the retirement health check. And the retirement advice consult is really for anyone who's got a little bit of an idea already or already on their way to that journey and has figured out a few of those steps and really just wants to, there's a change in circumstances. What's that going to look like? Or in a situation like Jenny's where she's like, look, I just want to weigh up retiring at this age versus that age and look at a comparison of that scenario. Or a lot of people quite financially literate already and feel like they have a really good structure around their retirement plans. So those people are better off in sort of retirement advice consultation. You just want to validate the plans. You want someone to raise a red flag and say, oh, probably could be doing that a little bit better. Let's make an adjustment. You want someone to make suggestions on how you might optimize your situation. Retirement advice consult for that one. So we offer sort of 3 levels of consultation. So entitlements consultation. This one is purely age pension discussion. Could be with the advice team, could be with the experts that we have in the customer service team in terms of the age pension knowledge. And so the really comprehensive age pension knowledge, have this conversation if you want answers specifically about how does age pension work, what might I be eligible for, my circumstances are changing, you know, how's that going to impact me, etc. Then we have the retirement health check, which we just covered off, which is an excellent starting point if you're at the beginning of your retirement journey. And the retirement advice consultation, that one's a little bit more comprehensive. We have a little bit more time and we can really work through the detail in comparing different strategies and optimizing your retirement situation. So those are services that we offer that we can help with. If you're confused about which of those options might be best for you, we actually just have sort of 10-minute phone appointments you can book. We'll give you a call. We'll chat about what your situation is and what you're looking for information on or guidance with, and we'll let you know which of those is the ones that we should be booking. And off to my favorite part, the question and answer session. So I'm really hoping we've got some good questions coming through.
Thanks, Nicole. Terrific session, very thought-provoking. And I think one of the things our advisors do so well is just to explain a lot of the complexities of Super and Centrelink in plain English. And I think the examples and charts that you took us through there were just really, really helpful. It's my pleasure now to introduce Kay Falak to host our Q&A session. Kay is an independent retirement commentator. She does some wonderful work for Retirement Essentials in telling stories of retirees from all walks of life. And you may well have read Kay's work in our weekly newsletter articles. So Kay will ask a series of your questions that have been coming through on retirement planning topics and scenarios, and these will be answered by our three senior financial advisors on hand today, Andrew, Amanda and Nicole. Over to you, Kay.
Thank you, David, and welcome everybody. I'm privileged to work with the advisors at Retirement Essentials because I watch them solve people's problems and I watch them save money. And it's just fantastic to be able to share the ins and outs of what they do. But let's jump in and get some of your tricky questions answered. We're going to start with Amanda. And Amanda, Wendy has asked, we would like to maximise our age pension. My husband is older than me. He qualifies for an age pension at the end of the year. I will not qualify for another 3 years. My question is, can I access my super when he's on the age pension and I'm 64? And after 3 years, when I turn 67, will Centrelink reassess my super balance?
Right, yes. Hi, Wendy. Yes, you can access super when your husband's receiving age pension and you're 64. Once you're over 60, you can withdraw from super if you've ceased an employment arrangement and you never intend to work again more than 10 hours per week. Check with your super fund for their particular wording. And then once you're over 65, there's no more cash in restrictions. So from that side of things, you can withdraw from super. And then while you're under the age pension age 67, your superannuation balance is not assessed by Centrelink and counting towards the assets test, as long as it stays within accumulation phase and you're not moving it into the account-based pension phase. So while it's in super, it's going to be exempt from counting towards the assets test. So there's a benefit there for your spouse's age pension entitlement. It's a temporary benefit because once you turn 67, regardless of whether if it's still in accumulation or pension phase, it's then going to start counting towards the assets test. So in that meantime period, you could increase your entitlement. There is a couple of things to keep in mind, and this is why your question's really good, Wendy, because Centrelink don't automatically update your superannuation balance of a spouse under 67. So when you turn 67, they're not keeping tab of from now till then, till 67, even though for the claim you will have been telling them that you have a superannuation, they're not going to be updating the balance like they do with an account-based pension for your spouse. So you do need to update them along the way. And then the other thing I think is, whilst you're under the age pension age, so from 64 to 67, the superannuation is going to be exempt in accumulation. and it's not going to be affecting the entitlement. But then if you were to withdraw that and put that into cash, then you would be expected to update Centrelink of that, because that cash asset will count as an asset. So there are a few little things to be aware of maintaining that. So when you get to 67, you need to inform Centrelink of your balance at that point. And then I think otherwise bigger considerations, bigger picture, and to touch on them, deferring, drawing, keeping superannuation in accumulation phase until you're 67 can help entitlement. And then the other thing is to think about reallocating the assets using the younger spouse strategy is something to think about in that situation, if you're in that situation like Wendy's. So there's my short, long answer.
Thank you, Amanda. And now thank you, Bronte, who's asking a question of Andrew. Is there an age limit for the recontribution strategy? Do you have to set up an accumulation super account to recontribute from the existing allocated pension fund and then start up a new allocated pension fund? Over to you, Andrew.
Thanks, Kay, and Bronte as well. That's a very good question. There is an age limit for the recontribution strategy. It's 75 where, again, just to repeat, the cash out and recontribution strategy is where you take money out of your super and essentially put it back in its most simplest form. Now, you can only contribute money back into super up until age 75 and 28 days to be precise. So if you are going to take the money out and put it back in, you want to make sure you have enough time to get it back in by that cutoff deadline. As to your second question, as noted, yes, super does exist in two phases, the accumulation phase and the pension phase. Once you have started an account-based pension, you can't add new money to it. So if you don't have an existing accumulation account, then you would need to open a new one to take the money out of the pension phase and put it into the accumulation account. From there, you can start a new pension account, or you could combine the account-based pension and the accumulation account and combine it together. And so that way, ultimately, you can ultimately end up with just the one account-based pension.
Thank you, Andrew. Sorry, you've wanted to add something.
I was just going to say, before you proceed, make sure you're across the contribution rules and limits on how much you can contribute into your super fund.
Thank you. Here's a short, sharp one for Nicole from Han regarding the income test for the Centrelink age pension. Does rental income, or is rental income based upon gross or net income for this assessment?
All right, that's actually an excellent question, Han, because it's so much trickier than it sounds. It is not the ATO's version of your net income, but it's also not the gross income. So there are some deductions that are allowable and some that aren't. If you want to nut it out in a bit more detail, we can probably make an entitlements consultation, but I will just say broadly, first of all, any non-cash items like depreciation, things like that, but there's also some really obvious things that you think would be deductible that aren't. And so unfortunately, I would say it's actually neither. It's generally somewhere in the middle. But if you have a mortgage against it, interest is on that mortgage is legitimately deductible, council rates, and maintenance and repairs on the home. A lot of other things outside of that you would expect to be deductible for age pension purposes are not. So that's a very, very interesting question, but a trickier one to answer given all the myriad of different deductions that you can have. But so short answer is it's actually neither. It's somewhere in the middle.
Thank you, Nicole. And if we thought that was tricky, wait till you hear what Karen is asking Andrew. Karen's talking about downsizing. When selling your home, does Centrelink exempt the entire proceeds of the house sale if you're in the process of buying another home? For example, we recently sold for $850,000. We're downsizing to a property worth $750,000. The house is being built and will be ready in 6 months. But Centrelink has only exempted the amount of $750,000. They've added the $100,000 difference in price to our assets. They are deeming the entire amount of $850,000 at the lower rate. Is that how Centrelink treats this scenario?
Thanks, Karen. The short answer is yes. You have touched on a complicated area, and what this refers to, just for the benefit of all those who are listening, is that when you sell your home, you generally when you sell the home, that asset is not assessed from a Centrelink perspective for up to 2 years. But you need to keep Centrelink updated as to the progress, and it's only not accessible if you are going to buy another home, which is the case in your case, Karen. So, but now that they know effectively what you'll be spending to finalise the purchase of the home, then that's what is not accessible, the $750,000, and now they're looking at it that you've got $100,000 left over, and that's essentially a gain and therefore accessible.
Thanks, Andrew. We've now got capital gains tax rearing its ugly head. 2 questions, Amanda, for you. They're similar but not the same. So Doug is asking, are there strategies available when you use super contributions to potentially reduce capital gains tax payable after selling shares? And Bridget asks, how can I best utilise super to pay capital gains? I have worked 40 hours this year and I am 74. I can repeat the second question if that's too much to handle.
I guess I get too far into it and forget what the question was. So I'll start with Doug's question first. So yes, strategy. There is strategies available with super contributions to potentially reduce capital gains tax. There are some considerations around it, I guess. So, and that's to do with when you are over 67 before turning 75, to be able to put money into super, yes, you can, as a personal voluntary contribution after tax. But to be able to claim a tax deduction, you either have to meet the work test or a work test exemption. So work test, this is where you've worked 40 hours in 30 days. So if you've met that condition, you can use the contribution, and that becomes a concessional contribution, and that's subject to the cap. So the cap at the moment for 1 year is 30,000. And of course, there is possibility, if your balance of super is below 500,000, that you can use catch-up provisions within that. So as always, it's one area where advice can be really helpful to go through your particular situation and work out where you're sitting with all of those different elements. And I think with Bridget, was it Bridget?
Yes.
Bridget. So Bridget's question sort of sounds as though Bridget's meeting that condition of that she's 74 and she's worked for 40 hours. So if it has to be in a 30-day period, so unfortunately, if you've sort of spread it out over time, it needs to count in that 30-day period. And with the work test exemption, potentially, if you've met that criteria in the financial year before, there's potential there. And then I think for Bridget, being 74, you've got that you've got that 75 upper limit for making contributions coming up. So like Andrew was saying before, be really aware on top of the rules that are applying to you to make sure that you meet it in time, because I think it's 28 days from the end of the month after you turn 75. So that could be, making sure that you've got all of your forms ready, all the paperwork done, so there's no potential delays and you meet your deadlines.
Thank you, Amanda. We're nearly out of time, but Danby has come in. He's interested in the retirement health check, and he wonders, because he and his partner are in their 40s, if it's useful for a couple to have that health check. And Andrew's offered to handle that question.
Thank you, Kay, and Danby as well. The retirement health check is helpful for, I would submit, for everyone. Now, advice. What is advice, and where does a retirement health check come into play? It comes at every stage, pretty much since you start working, and it's all based around what your goals are. Now, goals change obviously over time, but once you have a clear idea as to what your goals are, and in relation to retirement, 40s is often when you do. Because by that stage you generally, you've had your kids, you've got the house with a white picket fence, and you can then start at least putting a left eye or both eyes on retirement, because you've taken care of other goals prior to that. And so by looking if you're on track now, or things you could do now to better your situation, is important. So I would encourage everyone to have a look at it as soon as you can.
Thank you, Andrew. And we are sneaking in one more. This is from Graham. And Amanda, we'd love you to answer this. Graham is asking, do I need to advise Centrelink of an inheritance I am receiving because he receives a part pension? If he is going to contribute the inheritance to his partner's super, his partner is aged 61, still works, and their super is in accumulation phase.
Right. Yes. So in terms of reporting to Centrelink, the general expectation is within a fortnightly period, they do want to know any significant changes in your circumstances. And significant technically is $2,000, but I mean, any significant changes. So receiving inheritance, definitely one of them, definitely be updating Centrelink. But what will happen is if you then also provide evidence, update them that it's going to be contributed into your younger spouse's superannuation, that then is not going to be counted until your spouse reaches age 67 or moves into pension phase. So the ultimate end will be that it won't affect the amount that you're putting into your younger spouse's strategy as a strategy, or will not be counting. So yes, it is a requirement. There's an expectation to update Centrelink on inheritance. And it can be also one of those times, significant change in circumstances where you're thinking about things, because there are considerations such as how to use an inheritance. If you're receiving a lump sum and you have a mortgage, and you put that towards reducing your mortgage, or potentially if you're future-proofing your home and put some of your inheritance towards home renovations, those are strategies which also won't affect your entitlement. But at the same time, in those situations too, yes, you'd be updating Centrelink that you've received that amount.
Lots to think about there, Amanda. Thank you for that, and handing back to David to wrap us up.
Thanks, Kay, and to our advisors for a really educational session. On behalf of Retirement Essentials, all of the team, I'd like to thank you all for joining us today. I think these sessions really remind us of the uniqueness of everybody's retirement journey and the decisions that we all face. And it's really clear that when it comes to Centrelink and Super, the more guidance you can get to keep up with the changing rules and how they affect you, the better the decision making. And I think our advisors really do a good job of putting those puzzle pieces together for our customers and helping with making really good and sound financial decisions and really putting you in control. Lastly, if you would like to discuss your own retirement plans, you can visit the website and book in to speak with one of our advisors via a consultation. You can reach us via email and phone. You will all receive an email following this session with some further links to articles that are referencing some of the topics that we spoke about and a booking link if you'd like to join us for a consultation. Thanks again for joining us today. It's been our pleasure to host you, and we hope to see you all again soon. Thanks very much.